over the past few weeks, David Einhorn, who is a very successful and very rich hedge fund manager, sat down with the ex-Fed chairman Ben Bernanke, and he was able to ask him some questions. One of the things that came up was Ben Bernanke said to David Einhorn that he is 100% sure that there will be no hyperinflation in the future. And David Einhorn was kind of taken back by this. And David Einhorn said, well, I'm not 100% sure about anything. Like, you mean like you're 99% sure? And how do you manage the risk of that 1% you're not sure about? And Ben Bernanke, the ex-Fed chairman, said, nope, I am 100% sure that the Fed has all the tools it needs, so there will be an absolute zero chance of hyperinflation in the future. Now, this should be kind of scary to you, because when someone is thinking that there is a 0% chance of something happening or a 100% chance of something happening, and I'm not talking about the sun coming up tomorrow morning. I'm talking about something as complicated and dynamic and huge as the U.S. economy, the largest economy on this planet. For an academic economist to be 100% sure about something is actually very common. The concern is what role this certain academic economist has and who is listening to them. So when I ran my 60-minute intensive this week, ran it on Wednesday, I talked about where I think the markets are going. And I want to share something with you, and I want to share that with you in the theme of this weekend's podcast. So the theme for this weekend is what leading indicators can help you. Now I'm going to show you one leading indicator that can help, that has been very successful at predicting very large downturns in the stock market, like really large downturns. In fact, it can foresee, the economy starting to contract. So I want to share that with you, and I think you're going to find some pretty neat things that come out of this. I have 3 pretty cool charts that I want to share with you, and then we'll wrap it up and you can have the rest of the weekend to yourself. Hey everybody, this is RC Peck with Fearless Wealth, and this is my weekend podcast. And I'm pretty excited to share these three charts, 3 images with you, because it really kind of shows us where we are. And I think a lot of times we get really connected to the morality of things. And I'm no different. Should the stock market be going up? Absolutely not. Should the Fed have dropped rates to 0? Absolutely not. Should this zero interest rate policy be going on this long? Absolutely not. But it is going on, and it's probably not moral. There's probably not a lot of morality in it, but we can't really change that. So we have to go with what's happening. So the first thing I just want to show you, and it's really all in the same thing. There's one thing I want to show you, but I'm going to show it to you 3 different ways, is look at the screen here. Now there's kind of 2 charts on the screen. So first look over here on the left. What you see is what's called the yield curve. So the yield curve is what yield is being paid for a 3-month bond, a 2-year bond, a 5-year bond, a 7-year bond, a 10-year bond, a 20-year bond, and a 30-year bond being delivered by the U.S. government. And when the yield is inverted, that means those short-term bonds, those 3-month and 2-year and 5-year, are actually paying a higher dividend yield than those longer-term bonds, the 10, the 20, and the 30-year. So literally, the government is paying you more for them to only borrow your money for 3 months than if they were to borrow it for 30 years. Now, when a yield curve is inverted, people are really scared. They're basically saying, I'm not willing to loan you money for 10 or 20 or 30 years. I'll loan you money for a very short period of time, but then I want my money back. And if you look at the section of this screen on the right, you'll see that that is a price chart of the S&P 500. Or if you didn't, it actually is a price chart of the S&P 500 going back to 1999. And you'll see that there's a red vertical line almost in the middle. And that's about, let's call it October 2006. Well, in October 2006, the yield curve, which is to the left of that price chart was inverted, which is a very strong indicator saying, hey, there's probably a recession coming. There's probably some pretty bad stuff coming up. Now, this yield curve got inverted a full year before the market topped. So this is not a timing indicator. This is more of a, hey, let's start to really notice and take notice what's happening, maybe shorten our stops, maybe get more conservative with our positions. So the yield curve is a great indicator on what has a high probability of happening in the future. Now, the yield curve going inverted did not know the market was going to fall 58%, just like back in 2000 when the yield curve was inverted, did not know the market was going to fall 50%, but they did. So the question is, what is the yield curve doing today? And I'm glad you asked that. So the yield curve today is not only not inverted, it is what some would consider a normal upward sloping yield curve where you give your money to the government for 3 months and they pay you almost nothing. You give your money to the government for 30 years and they pay you a lot more, relatively speaking to what they would pay you over that 3-month period. So you give your money to the government, U.S. government, for 3 months and they give you, 2 basis points, which is 0.002%. I may have the one extra zero in there. But if you give it to them for 30 years, they give you 3.5%. Now, that coincides with May 8th of this year. And if you look at the price chart to the right, you'll see that red line is way, way, way over to the right. It almost looks like a border on the price chart, but it's way over to the right. So the yield curve is not inverted today. In fact, it's pretty steep, going from basically 0 to 3.5%. Should the government only be paying you or anyone who wants to loan them money for 30 years, 3.5%? Probably not, but that's what they're paying and people are buying it. So the yield curve is not saying we have some sort of huge recession in front of us. Again, this is through manipulated markets. This is through the Fed dropping interest rates to 0 for a very long period of time. I think they will stay at 0 longer than we can even imagine. Money printing will stop in the next 4 months, at least from the Fed's point of view. I'm sure Europe will pick it up. Japan is printing money. China is printing money. And so other major central banks around the world are printing money. And there's only so many places someone can put their money on planet Earth, and one of those places is the U.S. stock market. So this is a pretty good leading indicator. Now, this is my third chart and my final chart, and what this is actually showing you is the yield of a 10-year Treasury minus the yield of a 2-year Treasury, and it's plotted on a nice, pretty chart. So you can see those red bars where it went inverted, it went below 0. Meaning you should never be getting money. You should never be getting paid more money for loaning the government your money for 2 years than for 10 years. But in fact, that has happened 4 times since 1995. And you'll see it happened once in 1998 when long-term capital management, a hedge fund that completely imploded and was going to take down the entire stock market, but the New York Fed came out and bailed it out. But then the market, the yield curve went inverted again in 2000, and this time there was no bailing out, and the market crashed 50%. You see it happen again in 2006 and 2007, and the market actually peaked in October of 2007. So this is definitely not a timing indicator, but it starts to give us kind of a range of whether we should be or should not be concerned. And I actually do not think we should be concerned with the stock market crashing right now. I actually do believe we probably have a 50% correction in front of us, one more left. Maybe not 50%, maybe that's being a little hypey, but probably a 35 to 40% stock market correction in front of us still. And most likely that will happen in the future, probably after the next presidential election, when the Fed can kind of relax a little bit. One thing that the U.S. market has in front of us is the 3rd year of the presidential cycle, which starts this October, which is in about 4.5 months. And that is the best, that October 1st to April 1st historically is the best period for the stock market over any 4-year period. And that's been seriously researched and looked into going back to 1965. So it's very likely the market will stay sideways and choppy and annoying and angering for the next 4 or 5 months, and then start to move up and have a nice breakout from October 1st to April 1st. And then from there, we may have to wait until the next president gets put into office for the market to crash or correct. But I actually don't see, at least my leading indicators, some things are getting a little wonky, like a lot of money is going into long-term government bonds. But again, I don't know if that's actually consumers putting money into that or if that's really governments around the world buying U.S. government bonds. It's hard to tell in this very manipulated market, but I don't see a huge crash coming. Could we have a correction? Could we have a 10% correction? Maybe even a 20%, though I don't even see a 20% because it feels like the Fed wouldn't even allow that right now. We could probably have a 10% correction. In fact, we're probably due for one. So right now, this leading indicator is kind of flashing. Don't worry for right now. And do your best to not confuse the morality or the emotions of whether the market should or should not go up with the probability of it going up or going down. Now, the one thing or the main point I really want you to take away this week is that it's almost impossible for the market to crash. Notice I didn't say correct or fall, but it's almost impossible for the market to crash with so much credit expansion. Now, I'm using the word credit. It's just another word for money printing. Deficit spending in governments, money printing by Japan, actual credit expansion in China, money printing in Europe, money printing in the US. That's all credit because most of that will never be paid back, at least not paid back in nominal terms. It'll be paid back in inflated currency units over the next couple decades. But it's almost impossible for the market to crash during credit expansion. So take that as just another step in really helping you get to where you want to be, which is really a future of security and safety and freedom. You guys take care, and I'll speak to you soon.